On June 6, 2025, just after the latest jobs numbers were released, President Donald Trump made a bold and public demand. He called on the Federal Reserve, the central bank of the United States, to slash interest rates by a full percentage point. On his Truth Social platform, he argued that such a move would act as rocket fuel for the American economy, pushing it to even greater heights. This wasn't just a minor suggestion. It was a significant and direct challenge to the Federal Reserve's current cautious stance. The president's call immediately sparked a debate among economists, policymakers, and everyday Americans about the right path forward for the nation's economy, especially coming at a time when things seem to be going fairly well on the surface. To understand this debate, we first need to grasp what interest rates are. Think of them as the cost of borrowing money. When you take out a loan for a car or a house, the interest rate is the extra amount you pay back to the lender. The Federal Reserve, often just called the Fed, sets a key interest rate that influences all other borrowing costs in the economy. By raising this rate, the Fed makes borrowing more expensive, which can help to slow down the economy and fight inflation, the rate at which prices for goods and services rise. Conversely, by lowering rates, the Fed makes borrowing cheaper, which encourages spending and investment, ideally stimulating economic growth. President Trump's argument for a rate cut is twofold. First, he believes that lower borrowing costs would supercharge economic activity, encouraging businesses to expand and consumers to spend more freely. He sees an opportunity to make the economy even stronger than it already is. Second, he has pointed to the massive national debt. With lower interest rates, the U.S. government could refinance its debt at a cheaper cost, potentially saving billions of dollars in interest payments. This, he contends, would free up money for other priorities and strengthen the nation's financial position for the long term, making it a strategic move for fiscal health. This public pressure campaign is happening against a backdrop of increasing tension between the president and the Federal Reserve. President Trump has been a vocal critic of Fed Chair Jerome Powell, who was appointed by Trump himself but has maintained the central bank's independence. The president has called Powell a disaster, blaming him for keeping borrowing costs too high, and in his view, holding back the economy's full potential. As Powell's term nears its end in May 2026, this public clash raises important questions about the future leadership of the Fed and the direction of America's monetary policy, putting a spotlight on an institution designed to operate without political influence. The catalyst for this recent clash was the May 2025 jobs report, which, on the surface, appeared quite strong. The U.S. economy added 139,000 new jobs, which was more than the 125,000 that most experts had predicted. This suggests that businesses are still confident enough to hire new workers. Furthermore, the unemployment rate remained low at 4.2%, a figure that indicates most people who are looking for a job can find one. A low unemployment rate is typically seen as a sign of a healthy and robust labor market, suggesting that the economy is on solid footing and doesn't necessarily need an extra boost from the central bank. However, a closer look at the report reveals why some people, including the president, might see things differently. While job growth was steady, it wasn't explosive. Some analysts argue that while the numbers beat expectations, they don't show the kind of runaway growth that would signal an overheating economy. More importantly, wage growth, while strong at an annual pace of 3.9%, is a double-edged sword. On one hand, higher wages mean more money in people's pockets. On the other hand, a rapid increase in wages can push businesses to raise their prices, which can lead to higher inflation, the very thing the Fed is trying to keep under control. This is where the Federal Reserve finds itself in a difficult position. For months, the Fed has adopted a patient and wait-and-see approach. After a series of rate cuts in 2024, they paused in early 2025 to observe how the economy would react. Their primary concern is inflation, which is still running slightly above their target of 2%. Fed officials like Cleveland Fed President Beth Hammack have stated they see no urgent reason to cut rates. They want to see clear and convincing evidence that the labor market is weakening significantly before they would consider making borrowing cheaper again, fearing that a premature cut could reignite inflation. The Fed's caution is also fueled by uncertainty stemming from the president's own policies, particularly around international trade and tariffs. Officials have noted that shifting tariff policies can complicate their job immensely. Tariffs can drive up the cost of imported goods, which can push inflation higher. This creates a challenging scenario for the Fed. If they cut rates to stimulate growth, they risk letting inflation get out of hand. But if they keep rates steady to fight inflation, they might slow the economy down more than they intend. This complex interplay of factors explains their current hesitant posture. Adding another layer to the debate is the recent action taken by central banks across the Atlantic. In early June 2025, the European Central Bank decided to cut its main interest rate by 1/4 point. This was not an isolated move. It marked the 8th time the ECB has lowered rates since June 2024. The situation in Europe is quite different from that in the United States. European economies have been facing weaker growth and cooling inflation for some time. The ECB's decision to lower rates is a direct response to these conditions, an attempt to encourage borrowing and spending to prevent their economies from stagnating or falling into a recession. President Trump was quick to point to Europe's actions as a justification for his own demands. He argued that if Europe is cutting rates, the United States should follow suit to remain competitive. His logic is that if borrowing is cheaper in Europe, it could attract investment that might otherwise come to the US. By keeping US rates higher, he suggests, America is putting itself at a disadvantage on the global stage. This comparison puts pressure on the Federal Reserve to consider international dynamics, not just domestic conditions when setting its policy, framing the decision as one of global economic strategy. However, the Federal Reserve sees the situation differently. Fed officials argue that monetary policy should not be a one-size-fits-all approach. The U.S. economy has for the most part been more resilient and has shown stronger growth and higher inflation than the Eurozone. Therefore, the policy response that is appropriate for Europe may not be appropriate for the United States. The Fed's mandate is to focus on domestic goals, maximizing employment and maintaining stable prices within the U.S., following another central bank's lead without considering the unique conditions of the American economy would be a departure from that core mission. This divergence in policy highlights a fundamental tension in a globalized world. While the Federal Reserve is officially independent and focused on the U.S., it cannot completely ignore what is happening in other major economies. The decisions made by the ECB can affect currency exchange rates, trade flows, and international investment, all of which have an impact on the U.S. economy. The Fed must therefore perform a delicate balancing act, staying true to its domestic mandate while remaining aware of the global economic landscape and the potential ripple effects of its decisions, a task made more difficult by direct political pressure. If the Federal Reserve were to give in to the pressure and cut interest rates, there could be several positive outcomes, at least in the short term. Lower rates would immediately reduce the cost of borrowing for both consumers and businesses. This could lead to a surge in spending on big-ticket items like homes and cars, as mortgages and auto loans become more affordable. Businesses might be more inclined to take out loans to invest in new equipment, expand their operations, and hire more workers. As President Trump suggested, this could indeed provide a powerful boost to economic growth and give the stock market a lift. However, such a move is not without significant risks, with inflation being the primary concern. The main reason the Fed has been hesitant to cut rates is that inflation is still above its 2% target. Pumping more cheap money into an economy that is already growing steadily could cause prices to rise more quickly. If wages and prices begin to spiral upwards, it could erode the purchasing power of consumers, making everyday goods and services more expensive. This would hurt households, especially those on fixed incomes, and the Fed might eventually be forced to raise rates even more aggressively to bring inflation back under control, potentially causing a sharp economic downturn. The credibility of the Federal Reserve is also at stake. The Fed's effectiveness depends heavily on its independence from political pressure. If it appears to be making decisions based on demands from the White House rather than on its own economic data and analysis, it could lose the trust of financial markets and the public. This could lead to greater instability, as investors might become uncertain about the future direction of monetary policy. Maintaining this independence is seen as crucial for long-term economic stability, ensuring that decisions are made for the health of the economy, not for short-term political gain. In summary, the path forward is anything but clear. We have a president calling for aggressive rate cuts to fuel the economy and ease the national debt, pointing to a strong jobs report and actions in Europe as his justification. On the other side, we have a cautious Federal Reserve, worried that a premature rate cut could unleash inflation and damage its credibility. They prefer to wait for more data before acting. The decision they make will have far-reaching consequences for everyone's financial well-being. This leaves us with a critical question. In this complex economic environment, what is the wisest course of action for the nation?